The world of exchange-traded funds (ETFs) offers a diverse landscape for investors seeking exposure to various asset classes. But within this landscape lies a terrain brimming with amplified returns and magnified risks, the realm of 3x leveraged ETFs. These potent financial instruments aim to deliver 3 times the daily performance of their underlying benchmark, potentially offering significant gains in favorable market conditions. However, their amplified nature introduces complex dynamics that warrant careful consideration before venturing into their domain. This article delves deep into the intricacies of 3x leveraged ETFs, dissecting their mechanisms, exploring their potential benefits and drawbacks, and equipping investors with the knowledge to navigate this potent, yet perilous, territory. Mechanism and design. At the heart of a 3x leveraged ETF lies the principle of borrowing. These funds employ various strategies, like using derivatives like futures contracts or swaps, to magnify the movements of their underlying index. Essentially, for every $1 invested in the underlying asset, the ETF holds $3 worth of exposure, achieved through this borrowed capital. This amplifies both gains and losses proportionally, leading to significantly magnified daily returns. Double-edged sword, amplified rewards and risks. The primary allure of 3x leveraged ETFs lies in their potential for magnified returns. A 1% rise in the underlying index translates to a 3% gain for the ETF, offering investors a potent tool for capitalizing on short-term market upswings. This can be particularly beneficial for traders seeking quick, leveraged exposure to specific sectors or indices. However, the magnified nature of these ETFs also amplifies losses. A 1% decline in the underlying index results in a 3% loss for the ETF, leading to rapid erosion of capital during downturns. The compounding effect of daily losses can be brutal, potentially wiping out an investor's entire investment if the underlying market plummets. Understanding key dynamics. Understanding the nuanced dynamics surrounding 3x leveraged ETFs is crucial for informed decision-making. Here are some key points to consider. Compounding effects. The daily compounding of gains or losses can significantly impact the long-term performance of 3x leveraged ETFs. Even small market fluctuations can quickly snowball into substantial gains or losses over time. Volatility drag. While leverage amplifies daily returns, it also magnifies volatility. 3x leveraged ETFs tend to experience significantly higher volatility than their underlying assets, increasing the risk of sudden and unpredictable swings in value. Expense ratios. 3x leveraged ETFs typically have higher expense ratios compared to unleveraged counterparts. These ongoing fees can eat into returns over time, further diminishing the potential benefits of leverage. Liquidity risk. Some 3x leveraged ETFs may have lower trading volumes, leading to potential difficulty in entering or exiting positions at desired prices, particularly during volatile market conditions. Suitability and applications. 3x leveraged ETFs are inherently complex instruments best suited for sophisticated investors with a significant risk tolerance and a sound understanding of market dynamics. They are not recommended for long-term buy-and-hold strategies due to the compounding effect of volatility and potential erosion of capital during downturns. However, they can serve specific purposes within certain investment strategies, such as short-term market bets. For tactical traders seeking to capitalize on short-term market movements, 3x leveraged ETFs can offer amplified exposure to targeted sectors or indices. Hedging strategies. In certain situations, 3x leveraged ETFs can be used to hedge existing positions by amplifying short exposure to offset potential losses in the underlying asset. Beyond 3x, exploring alternatives. Investors seeking leveraged exposure should acknowledge the inherent risks associated with 3x ETFs and explore alternative instruments. Some potential options include 2x leveraged ETFs, offering less volatile exposure compared to 3x ETFs. These instruments provide double the daily return of the underlying asset while still amplifying market movements. Leveraged mutual funds. While less common, some leveraged mutual funds offer similar exposure with potentially lower expense ratios compared to leveraged ETFs. Option strategies. Certain option strategies can replicate the effects of leverage while offering greater customization and potentially limiting downside risk. Risk management and due diligence. Investing in 3x leveraged ETFs requires a proactive approach to risk management. Here are some essential steps to consider. Clearly define investment goals, understand your specific objectives, and ensure the risks associated with 3x leveraged ETFs align with your overall risk tolerance. Thorough research. Conduct meticulous research on the specific ETF, its underlying index, and the historical performance of similar instruments. Stop-loss orders. Utilize stop-loss orders to automatically exit positions if losses exceed set thresholds, mitigating potential damage during market downturns. The intricacies of 3x leveraged ETFs extend beyond the basic mechanics and risk factors. Delving deeper, we encounter advanced considerations and real-world applications that require a nuanced understanding of these potent instruments. Beyond daily performance. While the focus of 3x leveraged ETFs typically centers on daily returns, understanding their performance over longer periods is crucial. This requires consideration of compounding volatility. The compounding effect of daily volatility can significantly impact long-term returns, potentially negating the benefits of leverage over extended periods. Backtesting performance against the underlying asset over multi-year horizons can reveal the potential erosion of capital over time. Expense ratio impact. The seemingly small expense ratios of 3x leveraged ETFs can have a significant cumulative effect over extended periods. Analyzing the long-term impact of these fees on potential returns is essential for informed decision-making. Tax implications. The amplified gains and losses generated by 3x leveraged ETFs can create complex tax situations. Consulting with a financial advisor to understand the potential tax consequences of these instruments is highly recommended. Case studies. Leveraging with caution. To shed light on the practical applications and potential pitfalls of 3x leveraged ETFs, let's consider two contrasting case studies. Case study 1, short-term market surge. Imagine an investor expecting a short-term rally in the Nasdaq Composite Index. They deploy a 3x leveraged ETF tracking the Nasdaq, aiming to amplify potential gains. If the Nasdaq soars by 5% in a week, the 3x leveraged ETF would experience a 15% gain, significantly outperforming the underlying index. This illustrates the potential benefits of leverage in capturing short-term market upswings. Case study 2, unexpected market downturn. Unfortunately, not all market movements align with investor expectations. Consider the same investor from the previous case study, this time encountering a sudden 3% decline in the Nasdaq. Due to leverage, the 3x leveraged ETF would plunge by 9%, representing a significantly higher loss than the underlying index. This scenario highlights the amplified downside risk associated with leveraged instruments, showcasing how quickly gains can turn into substantial losses. Beyond basic applications. While short-term market bets and hedging strategies represent common uses for 3x leveraged ETFs, these instruments can be incorporated into more advanced portfolio strategies, including Dynamic asset allocation. Leveraged ETFs can be used to adjust portfolio exposure to specific asset classes based on market conditions, potentially amplifying returns during favorable periods and mitigating losses during downturns. Income generation strategies. Certain leveraged ETFs tracking dividend-paying assets can be employed to generate enhanced income, although careful consideration of volatility and expense ratios is essential. Market timing strategies. Experienced investors with a high-risk tolerance may utilize 3x leveraged ETFs within well-defined market timing strategies, attempting to capitalize on short-term market inefficiencies. The final word: tread carefully. Knowledge is key. 3x leveraged ETFs offer alluring possibilities for amplifying returns, but their power comes with substantial risks. These instruments are not suited for all investors and require a deep understanding of their mechanisms, limitations, and potential pitfalls. Thorough research, risk management strategies, and a clear understanding of investment goals are paramount before venturing into this high-stakes terrain. Ultimately, 3x leveraged ETFs should be treated as potent tools, wielded with caution and within a comprehensive investment strategy, by those possessing the necessary knowledge and risk tolerance to navigate their volatile embrace.